Welcome to the deep dive. Today we're jumping right in to unpack the latest from IndusInd Bank, India's fifth largest private bank. We've got their Q1 FY26 financial results here, and our mission really is to break down what these numbers are telling us about their health and where they might be headed.
Yeah, it's a really interesting case study, isn't it, how a major bank navigates, a pretty complex economic environment. You've got strengths, but also some clear headwinds.
Exactly. Can that impressive digital push offset some of the profitability challenges and the recent leadership changes? Let's find out.
We'll walk you through the details, try and connect the dots for the bigger picture.
Okay, so let's start with that overview, the initial snapshot. The summary paints this picture of IndusInd Bank built on a pretty strong foundation.
Right.
Robust balance sheet, solid capital adequacy, and this truly massive distribution network across India.
Which sounds great on the surface.
It does sound promising, but then right alongside that, they mention significant declines in key profitability metrics compared to last year. So it's a bit of a contrast right off the bat.
That juxtaposition is striking. You have these structural advantages, the network, the successful digital side.
Yeah, that 93% digital transaction mix is remarkable.
It really is. But on the other hand, this noticeable dip in profitability for the quarter, especially year on year, it makes you ask, okay, what's driving those profit declines despite these underlying strengths?
That's the puzzle, isn't it? Let's dive straight into the core financials for Q1 FY26 then, get a clear view. Total loans, for instance.
Okay.
They contracted slightly, came in at just under 3.34 trillion rupees. It's a 4% decrease year on year and 3% down quarter on quarter. So the loan book shrank a bit.
Right, and that contraction, you see it mirrored on the deposit side too.
Yeah.
But maybe what's more telling is the shift happening within deposits.
Yeah, good point. Total deposits were also down 3% quarter on quarter, almost 4 trillion rupees. And within that, CASA, current account, savings account deposits, they took a pretty big hit, down 14% year on year and 7% quarter on quarter. CASA now makes up about 31% of their total deposits.
And that 14% year on year drop in CASA, well, that's a bit of a flashing yellow light for any bank.
Why that?
Because CASA funds are usually the cheapest source of funds, right?
Well,
they're crucial for keeping net interest margins healthy, especially when interest rates are competitive.
okay.
So that decline suggests IndusInd might be, paying more for its funding, and that directly squeezes profitability. It also kind of hints maybe customers are shifting towards higher yielding term deposits.
Which actually we saw grew 8% year on year. Although, interestingly, they also declined 1% quarter on quarter, so a bit mixed there too.
Still, the CASA trend points towards pressure on their cost of funds.
Definitely a challenge. Now, net interest income, NII. The bank's core earnings from lending, that was around 4,640 crore rupees. Now, this is interesting. It's a 14% decrease year on year, showing that pressure we talked about. But it's a substantial 52% increase quarter on quarter.
Yeah, see, that's a very mixed signal. That big quarter-on-quarter jump in NII, it does suggest maybe some positive momentum or perhaps some one-off factors just in the last 3 months.
Right.
Maybe a glimmer of recovery after a weaker previous quarter. It complicates the simple year-on-year negative story.
And it's a similar kind of story with total other income. Came in around 2,157 crore rupees. Again, down 12% year on year. But a massive 204% increase quarter on quarter. When you look deeper into that other income, though, the year-on-year picture shows broad declines, cards, distribution fees, banking fees, trade, forex, all down significantly compared to last year.
So if you're connecting this to the bigger picture, you're definitely seeing that narrative of year-on-year contraction and overall profitability.
Yeah, very clearly.
It's dark in the net profit, operating profit, the margins, but those strong Q-o-Q increases in NII and other income, well, they suggest either some specific one-time gains or maybe a notable rebound from a particularly weak Q4. It's a mixed bag, really. Needs a closer look at what's driving both trends.
Absolutely. And when we look at the total revenue figure, around 6,797 crore rupees, down 13% YoY, but up 81% QoQ. But despite that quarterly jump, the operating profit was 2,568 crore rupees, and that's still down a substantial 35% year on year.
Right.
And the bottom line, net profit, PT, 604 crore rupees. That's a sharp 72% decrease year on year.
Wow, yeah. That 72% year-on-year drop in net profit is quite a headline number. It really underscores the pressure they face compared to Q1 last year. Big hit to core earnings power.
And their net interest margin, that crucial measure of loan profitability versus deposit cost, it dropped to 3.46%. That's down 79 basis points year-on-year.
Significant margin compression.
Yeah. And their cost-to-income ratio, that increased up to 62.23%. Return on assets, ROA, how efficiently they use assets to make profit, that was only 0.45%, down 125 basis points year-wide.
Ouch.
And return on equity, ROE, the return on shareholder investment, 3.71%. A huge decline of 981 basis points year-on-year.
So these declining margin and return ratios, NE, ROA, ROE, they're critical indicators. Basically, they tell you the bank's generating less profit for every rupee of assets or equity it has compared to last year.
Right.
It just directly outlines those severe profitability challenges you mentioned. Suggests maybe broader operational or funding pressures are really biting.
So, okay, with that financial picture, let's pivot a bit. How is the bank actually putting its money to work? What does the loan book tell us about their strategy? We're told it maintains a 60.40 mix, retail versus wholesale loans.
Which is fairly standard for a universal bank,
Yeah.
Balancing the higher volume, maybe higher risk reward of retail with the stability you often get from corporate lending.
Makes sense.
But that 60% in retail clearly highlights their strategic focus on the consumer side. And within that, vehicle and microfinance are pretty significant pieces.
Yeah, let's break that down. Consumer banking is 60% of advances, just over 2 trillion rupees.
Right.
Vehicle finance is the biggest chunk of that, 29% of total loans, or about 96,000 crore. Microfinance is 8%, around 28,000 crore. Corporate banking is the other 40%, about 1.3 trillion rupees. Mostly large corporates, that's 22%, and mid-corporates at 14%.
Okay.
And if we drill down even further, look at where the revenue and profit actually come from within those segments.
Yeah.
It gives you a clearer idea of their operational engine.
Yeah, where the money's really made.
Exactly. Treasury operations, like 37 crore rupees revenue, 118 crore profit. Corporate wholesale banking, revenue just over 3,100 crore, profit around 960 crore.
Okay, significant. But watch this next one.
Right. Retail banking, which they split into digital and other retail, had a massive revenue, nearly 9,500 crore rupees.
Wow.
And a profit of just over 3,000 crore rupees.
So that breakdown really hammers home the point, doesn't it? Retail banking is absolutely the dominant contributor to both the top line and the bottom line for IndusInd.
Undeniably their core.
Yeah, that strategic focus on the consumer loan mix, it clearly translates into the biggest financial returns for them.
And just for completeness, other banking business reported about 688 crore revenue and 730 crore profit. Okay, now, asset quality. Always crucial for a bank.
Very important.
We learned that gross non-performing assets, GNPA, went up. Rose to 12,481 crore rupees in Q1 FY26, up from about 11,000 crore the previous quarter.
Right.
That pushed the GNPA ratio up to 3.64%. And net NPAs, NNPA, also rose to 3,721 crore from about 3,300 crore. The NNPA ratio is now 1.12%.
Right, so this raises an important point. While they maintain their provision coverage ratio, which we'll get to.
Yes, 70%.
Which is healthy, yes. But the clear increase in both gross and net NPA ratio as well, that's a trend you have to watch closely. Rising NPAs can directly hit future profits because you need higher provisions. They basically eat into earnings.
So that 70% provision coverage ratio, PCR, that's a good sign of preparedness, right? Total loan provisions were about 10,500 crore, representing 3.14% of their loans. But the fresh additions to NPAs in this quarter were 2,567 crore rupees, while deductions, things like write-offs, recoveries, upgrades, only totaled 11,133 crore.
Ah, okay. So the additions to bad loans significantly outpaced the resolutions or write-offs.
Yeah.
Which directly explains why the overall GNPA numbers went up. It suggests more loans are, well, turning sour than are being fixed or removed from the books. That's definitely a concern for asset quality.
And interestingly, digging into consumer banking specifically, the gross NPA percentage there was 4.74%.
Okay.
But microloans within that segment showed a particularly high rate.
Yeah.
16.39%. That number really jumps out.
It does. That 16.39% GNPA in microloans is, particularly noteworthy. It strongly suggests a specific pocket of stress within their consumer book.
Is that industry-wide or specific to them, do we know?
It could be a mix. Microfinance inherently carries higher risk, and maybe specific economic pressures are hitting that borrower segment hard, but it's definitely a key area where IndusInd's asset quality issues seem more pronounced right now.
Okay. But despite those asset quality numbers, it's important to look at their capital adequacy, their financial cushion.
Absolutely critical.
Their CRAR, capital to risk-weighted assets ratio, stood at 16.63%, and that excludes the Q1 profit. Their CET1 and Tier 1 ratios were both 15.48%. Tier 2 was 1.16%.
Right, and those figures are well above the regulatory minimums. This is really key. Even with the profit challenges and the rising NPAs we just discussed, the bank maintains a very healthy capital buffer. That gives them a strong cushion against potential future shocks. It's a significant sign of underlying stability.
So they have capacity to absorb losses or invest.
Exactly. It means they have the financial strength to handle potential losses from those NPAs or to fund growth initiatives, even while profitability is under pressure. Got it. Okay, let's shift to the operational side now. How they actually reach customers. They serve 42 million customers, massive network, 7,211 touchpoints across India. That includes over 3,100 branches and outlets, plus over 3,800 BFIL branches and more than 3,000 ATMs, and a deep rural presence covering about 164,000 villages.
That physical network, especially the rural reach, it's a huge asset. It gives them access to a diverse customer base that maybe digital-only players would struggle to reach. It's a foundational strength.
Imagine the logistics of covering 154,000 villages. But then you layer on top of that their digital footprint, and this is where it gets really interesting.
Yeah, that 93% number again.
That overall digital transaction mix of 93% for a bank this size is, well, it's incredibly high. And their main mobile app, IndusInd, showing really strong growth. Monthly active users, MAU, up 2.6 times quarter on quarter. Fixed deposit bookings on the app up 220% QOQ. New savings accounts opened via Indy up 292% QOQ. And mutual fund bookings through the app surged 600% QOQ. See, this data on digital adoption, it's a huge positive story for them. It clearly points to a very successful digital transformation strategy. This could be a key differentiator for them long term.
How so?
Well, it suggests they're using tech effectively to streamline operations, improve the customer experience, and reach more people efficiently. The rapid growth in things like MAU and bookings shows real customer buy-in. It's potential for future growth.
And they've also got Indy for Business aimed at MSMEs. That saw MAU up 129% QOQ, and they hit 100,000 MSMEs registered in less than 6 months. That's fast. Plus, their digital do-it-yourself or DIY assets, things like online loans, saw estimated net revenue grow 53% year-on-year, and DIY loan dispersals up 60% year-on-year.
The success with Indy for Business just further highlights their digital capability, expanding into that crucial small and medium enterprise segment. This dual-focus consumer and business digital platforms, it really paints a picture of commitment to digital-first banking. It could be a powerful engine moving forward.
Okay, so let's try and bring this all together now. Looking explicitly at the challenges they've identified or that we've discussed. First, obviously, that significant decline in profitability.
Right.
Net profit down 72% YOY, operating profit down 35% YOY, NEM down 79 basis points YOY. That's the big one.
Yeah, that drop in profitability is the most immediate financial hurdle, hitting their core earnings compared to last year. It's a fundamental pressure point.
Then there's the contraction in both loans and deposits, which raises questions about growth momentum.
Potential growth issues.
And we can't ignore the rising NPA ratios, especially that really high number in microloans.
Definitely a key challenge.
Plus, an increase in cost-to-income ratio, now at 62.23%, suggests maybe efficiency challenges or higher costs are eating into their margins.
Yeah, that rising cost-income ratio basically means for every rupee of income they generate, more of it is being spent on operational costs, directly impacting the bottom line. So this whole list, it shows that while the bank has strengths, it's definitely navigating some significant headwinds right now, operational and internal.
And speaking of internal, a very important point that touches on controls. The bank identified and accounted for some discrepancies from FY25.
Yes.
Related to derivative trades, MFI portfolio income, and some manual entries. They said they set up a project management group to tighten systems and controls and initiated disciplinary action against the staff involved.
The fact that they acknowledged those issues from last year, the derivatives, the MFI income, and took action, well, that's a critical step. It's about reestablishing confidence.
It seems proactive.
It does. But it's not just accounting cleanup, right? It points to potential internal control weaknesses that the new leadership will absolutely need to tackle head on. It makes this a really pivotal moment for their governance and, frankly, for trust.
Okay. So pulling it all together, What does this mean for someone trying to get a handle on IndusInd Bank? What are the key takeaways?
All right.
First, profitability is under pressure. That big year-on-year drop in net profit, operating profit, NIM, ROA, it clearly signals a tough quarter for core earnings. That seems like the most immediate worry.
Agreed. Second takeaway, asset quality deterioration. The rise in both gross and net NPAs, especially in consumer banking and those microloans, it needs close watching. Monitoring that trend is key, because if it continues, it means higher provisions hitting future earnings. It's a clear sign of stress in the loan book.
But then the flip side, digital leadership and growth. Yeah. That 93% digital transaction mix, the rapid growth of the Indie apps, it shows a really successful digital transformation. That could be a huge long-term advantage for them.
That digital strength isn't just about saving costs. It's about future-proofing the bank, improving customer engagement. It can drive growth even when other areas are challenged.
Okay. Fourth takeaway, capital strength. Despite the profit issues, they've got healthy capital ratios. That 16.63% CAR provides a strong buffer.
Yeah, that robust capital base is a crucial safety net. Yeah. It means they have the financial muscle to absorb potential losses from those rising NPAs or to invest in growth, like you said earlier.
And finally, a big one, leadership transition and governance. The MD and CEO resigned. The board's taking steps that project management group disciplinary actions. It shows a clear focus on governance and internal controls.
Right.
And importantly, they announced they'll finalize the new MD and CEO appointment by August 28th, 2025. The RBI approved a 1-month extension for the interim setup to ensure, a smooth transition and stability.
So yeah, connecting it all to the bigger picture. It's a bank facing these short-term financial pressures, internal challenges too, but it has these strong foundations, good capital, really impressive digital innovation. The leadership change and the focus on fixing those past discrepancies, those are vital steps for stability and rebuilding confidence, which leads to the big question, really.
Yeah.
How will the incoming leadership leverage those digital strengths and that solid capital base to effectively tackle the profitability and asset quality issues, especially given those tough year-on-year numbers we saw? That's the key thing to watch going forward.
That was quite the deep dive into IndusInd Bank's Q1 FY26 results. A really fascinating mix, wasn't it? Clear challenges, but also some definite strengths, especially on the digital front.
It really highlights how complex banking can be and how important it is to look beyond just the headline profit number to understand what's really going on.
Absolutely. So here's a provocative thought for you to mull over. How much can a strong digital backbone and robust capital really help a bank navigate serious asset quality problems and a major leadership transition, especially in today's fast-moving market? And just a quick disclaimer before we wrap up, we are not SEBI-registered financial advisors. If you are considering making any and many decisions based on this, please consult with a certified financial advisor first.
Always good advice.
Thanks for joining us on this deep dive. Hope you feel a little more well-informed. We'll see you next time.